Stop looking at the price of silver on your screen. It might say silver is around $91 an ounce. But in the physical world, in cities like Dubai and Tokyo, people are paying over $130 for that exact same ounce. That is not a dealer markup. That is a system failure. When a system allows two wildly different prices for the same asset, it is broken. And when these systems break, they don't just bend, they shatter. Silver is now flashing the same final warning Bitcoin did just before its historic breakout. A dangerous gap is widening between the paper price and the physical reality. This isn't a theory, it's not an opinion. This is about market mechanics. And mechanics always win. So let's decode those mechanics. Together, we will establish 4 facts the market is trying to hide. First, the physical silver shortage is no longer debatable. It's a mathematical reality, and it is accelerating. Vault inventories are collapsing, and the costs to secure delivery are spiking, signaling extreme physical tightness. Second, the price you see on your screen is becoming an illusion, artificially suppressed by a mountain of paper contracts designed to absorb demand that would otherwise chase a shrinking physical supply. Third, a disconnect this severe is unsustainable. History proves that when paper markets fight physical reality, the correction is never gradual. It is violent. And fourth, Bitcoin already wrote the playbook for this. In 2020, massive physical accumulation happened in the shadows, hidden from the screen price. Silver is now in the exact same phase of hidden accumulation. Let's start with what's happening in the physical world, because most people don't see it. For 5 consecutive years, the silver market has been in a structural deficit. We are consuming far more silver than every mine on Earth can produce. The total deficit has now erased nearly 800 million ounces from existing stockpiles. Think about that. Almost an entire year of global mine production has simply vanished to meet demand. So where did it come from? Decades of stockpiles. Vaults in London and New York are being systematically drained. Inventories at the COMEX, a key futures exchange, have plummeted by over 70% since 2020. These are not just warning lights, they are sirens. But the clearest signal of all is the premium. The paper price might say $91, but in the real world, buyers are paying over $130 for a single ounce. This isn't a retail markup. It's a global distress signal. It shows that major buyers want the asset, not the promise. And they want it now. This is where the structure really starts to fail. If physical demand is this extreme, why has the screen price remained so suppressed? The answer lies in the paper market, which is built to create an illusion of supply. A synthetic supply created through leverage. The modern silver market is essentially a fractional reserve system for a physical commodity. For every 1 ounce of real deliverable silver, there are hundreds of paper claims trading against it. Some credible estimates place this paper to physical ratio as high as 350 to 1. These are futures contracts, unallocated accounts, and ETF shares. This extreme leverage serves one primary function: to suffocate true price discovery. When you can create 350 paper ounces for every 1 physical ounce, the price no longer reflects physical reality. It only reflects the supply and demand of paper. Even silver ETFs, which seem like a direct investment, can function as a pressure release valve. They offer exposure to the silver price without requiring the fund to immediately source the physical metal for every share bought. But an ETF share is just a claim. A fund cannot print silver. If the day comes when physical metal is unavailable, that claim will face its moment of truth. The system is a coiled spring, a gigantic amount of paper leverage pressing down on a rapidly shrinking pile of physical metal. Paper is delaying reality. But leverage has never permanently defeated the laws of supply and demand. If this structure sounds unstable, it is. And we have seen this exact mechanical failure before. To see where silver is going, you only need to look at Bitcoin's 2020 blueprint. Signal 1 was hidden accumulation. Throughout 2020, while Bitcoin's price traded mostly flat, institutions were acquiring enormous amounts through over-the-counter, OTC desks, and private deals. This demand was invisible to anyone just watching the exchange price. The same pattern is happening in silver, but at a sovereign level. Nations are reclassifying it as a strategic asset. The US has officially added silver to its list of critical minerals. Russia is reportedly allocating funds for its national reserves. And in a pivotal move, China implemented significant export controls on January 1st, 2026, to secure its own domestic supply. This is global, sovereign-level accumulation that the paper market is designed to ignore. Bitcoin's historic run didn't start when institutions began buying. It started when the system could no longer hide it. Signal 2 was the tension in the futures market. Just like silver today, Bitcoin in 2020 saw a massive buildup of leveraged paper contracts that kept the price contained. When confidence finally cracked, that leverage was forced to unwind. The price didn't just rise, it snapped upward violently to reconnect with reality. The mainstream buyers, the ETF approvals, the flood of retail investors, they came after the breakout was already underway. They chased the move. They didn't cause it. The breakout began when the physical supply on exchanges was exhausted, and the sellers simply vanished. So what is the trigger? What is the pin that pops this paper bubble? It comes down to a sequence of 3 mechanical failures. First, margin stress. The entire paper leverage system is held together by collateral. A sudden spike in volatility can cause exchanges to raise margin requirements instantly. This creates a doom loop. Leveraged players are forced to sell, which creates more volatility, which triggers more margin calls. The leverage shatters itself. Second, a delivery failure. A futures contract is a promise to deliver the physical asset. The moment a large buyer stands for delivery and the metal is not there, or is only available at a staggering premium, faith in the entire paper market can evaporate. Instantly. We are seeing the tremors of this now, with spiking lease rates and inventories at historic lows. But the final and most powerful trigger is simply a loss of confidence. It's the moment the market truly realizes 350 paper claims cannot be settled by 1 physical ounce of silver. A bank run on the physical metal begins. Everyone tries to convert their paper promise into the real asset all at once. This is precisely what happened with Bitcoin, as investors rushed from paper claims to self-custody. The price was forced to find its true physical clearing level. Here's the bottom line. Paper prices are anchored by confidence. Physical prices are anchored by scarcity. And confidence can evaporate over a weekend. Scarcity cannot. Let's be perfectly clear. Nations are hoarding silver as a strategic asset. The physical market is breaking away from the paper market, and the price gap is widening. The system is attempting to suppress this reality with synthetic supply created through leverage, but the cracks in its foundation are spreading. This is not a prediction of when this structure will break. It is an explanation of the mechanics for how it will break. When an asset's price is dictated by paper leverage instead of physical scarcity, the repricing event is never slow and orderly. It is sudden and violent. Bitcoin did not break out because of a new narrative. It broke out because the paper system, hiding the overwhelming physical demand, finally failed. Silver is flashing the exact same mechanical signals today. The disconnect between a $91 paper price and a $130 physical reality is not just a data point, it is a final warning. The price on the screen is not the market. It is the price inside the paper casino. The real market is revealed in the physical premiums, the emptying vaults, and the actions of nations. Your job is to understand the difference between the price and the value before the headlines catch up.